You know both their names. You've probably had both of their chocolates, but few realize just how different these two companies are under the hood. On one side, you have got Hershey's, founded in 1894, still rooted in Pennsylvania and laser focused on US confectionery. On the other hand, you have Mondelez International, a global snack empire that controls Oreo, Cadbury, Toblerone, and 50 other brands across 160 countries. Same category, totally different playbook. This is not just a battle of chocolates, it's a story of scale versus focus, global versus domestic, acquisitions versus brand depth, and how two giants can serve the same craving but follow completely opposite business paths. In this breakdown, we'll compare Mondelez and Hershey's across 9 key chapters, from revenue models and product segments to global strategy and stock performance. You'll see how the 2008 crash and the 2020 pandemic shaped them, how each builds innovation differently, and why their valuations have started to converge. By the end, you'll understand not just who's winning today, but who's better positions for what's next. So let's break it down. Chapter 1: Origin Stories and Structural DNA. Start with where they came from, and you'll understand why they are so different today. Hershey's, like I said, began in 1894 when Milton Hershey founded the Hershey Chocolate Company in rural Pennsylvania. The original goal was to make chocolate affordable for American families. Over time, that mission evolved into a tight-knit US confectionery business centered on a few mega brands like Reese's, Kit Kat US license, and Hershey's bars. Importantly, the company that is still controlled by the Hershey Trust, a foundation set up to fund a school for underprivileged children, which gives the company a rare long-term orientation and strong resistance to hostile takeovers. Mondelez, meanwhile, wasn't even born until 2012. It was a spun-off from Kraft Foods as the global snacking division, carrying with it decades of legacy brands like Oreo, Ritz, Cadbury, Toblerone, and Trident. The company's global DNA came not from one founder, but from aggregation of Nabisco LU and Cadbury into a single portfolio. That now portfolio spans over 150 countries. Its shareholder base expects consistent global expansion and the M&A execution. So from day one, Hershey prioritized control and domestic dominance. Mondelez was built for scale, scope, and international complexity. That structural DNA still drives how they grow, where they sell, and what risks they are willing to take. Now coming to Chapter 2, Revenue and Growth Engine. Here's the size gap. Mondelez earned $36.44 billion in revenue and $4.61 billion in net income in FY 2024. Hershey's $11.20 billion in revenue and $2.22 billion in net income. But it's not just about the size, it's about how they got here. Hershey's has grown steadily and predictably, mostly within the US. It doubled revenue from $5.1 billion in 2008 to $11.2 billion in 2024, driven by core brand strengths, seasonal sales spikes, and bolt-on acquisition like Dot's Pretzels and Skinny Pop. Annual growth typically falls in the range of 2 to 5%, with pricing and product extensions doing most of the lifting. Mondelez, by contrast, has had a more winding road. After its 2012 spin-off from Kraft, it shed grocery brands, battled currency headwinds, and saw revenue dip to $26 billion by 2016. The turnaround came through portfolios focus and acquisitions like Tate's Bake Shop, Cliff Bar, and Chipitia. By 2024, it climbed back to $36.4 billion in sales, though net income fell 7% year over year. The inflection points: Hershey held steady through downturns including 2008 and COVID. Mondelez took longer to stabilize, but it is now building speed, especially in emerging markets. Chapter 3: Profitability, Margins, and Operating Leverage. Revenue tells you who is big, margins tell you who is efficient. And here, Hershey outperforms. In 2022, Hershey's operating margin was 22%, supported by a domestic supply chain and tight portfolio. It runs gross margins around 45% with EBITDA margins consistently in the mid-20s. Even with rising input costs, the company squeezes strong profit from every dollar of sales thanks to a high concentration of premium chocolate, price leadership, and scale within the US retail system. Mondelez, despite its larger size, operates with lower margins, but they have been rising. Post 2015 restructuring and cost cutting lifted its adjusted operating margin from 12% to 17 to 18% in 2023. Its gross margin hovered near 39%, with room to improve as higher margin chocolate expands within its portfolio. Mondelez still faces higher logistics and currency friction due to its global spread, but automation and supply chain reinvention are helping. Recent pressure were the cocoa prices. In 24-25, both companies flagged margin compression from cocoa cost inflation. Hershey's guided for a 36% earnings drop, while Mondelez, with more diversified categories and markets, showed more resilience. The takeaway here is that Hershey's is more profitable today, but Mondelez is catching up and has more levers across markets and categories to scale margin over time. Chapter 4: Business Segments, Products and Portfolio Mix. Now, both sell snacks, but what they sell, how much of it looks very different. Hershey still earns about 90% of its revenue from confectionery, mostly chocolate. Think Reese's, Kit Kat, Hershey's bars. The remaining 10% comes from salty snacks, a newer segment built through acquisitions like Dot's Pretzels, Pirates Booty, and Skinny Pop. It's growing fast. In some quarters, salty snacks saw a 70% year-over-year growth, but still small in absolute terms. Mondelez is much more diversified. About 80% of its business comes from biscuits and chocolates, which is Oreo, Chips, Ahoy, Ritz on the side, Cadbury, Milka, Toblerone on the other. The rest, gum, candy, and baked snacks like Cliff Bars and cake brands from its Chipity acquisition. Now the strategic shift is clear. Mondelez is shedding gum and minor brands to focus on chocolate, biscuits, and bars. Hershey's is doing the reverse, holding chocolate steady while using acquisitions to build a broader snack house in North America. So while both are expanding their category base, Mondelez is wide by design and Hershey's is branching out from a single stronghold. This mix not only shapes marketing and innovation, it defines where future growth is likely to come from. Chapter 5: Geography, Domestic Focus versus Global Spread. Now, geography might be single biggest difference between these two companies. Hershey's is mostly domestic. As of 2023, over 85% of its revenue came from North America, mostly the US. Its international operations in places like Mexico, Brazil, and India are small, and its biggest global push, China, was wound down after underperformance. Hershey's exited direct operations there in 2020, focusing instead on selective exports and licensing. Mondelez, by contrast, is truly global. In 2024, it earned about 36% of revenue from Europe, 30% from North America, and the rest from emerging markets like India, Brazil, China, and Southeast Asia. In India alone, Cadbury commands a near monopoly in chocolate with 70% share. Now, why does that matter? Because global spread gives Mondelez exposure to faster growing markets, but also comes with more volatility. Currency swings, regulatory differences, and supply chain fragility all comes with scale. Hershey's bet is a little different: go deep, not wide. Its model depends on seasonal spikes like Halloween, US distribution muscle, and loyalty to iconic brands. So one giant owns America's sweet tooth, the other is chasing billions of snackers worldwide. Chapter 6: Innovation and New Product Strategy. Now, innovation reveals a company's intent and how it sees the future of its category. Now, Mondelez invests heavily in it. With over $400 million in R&D spent annually, it runs innovation centers worldwide and uses local feedback to shape products. Oreo is its flagship here, launched in over 100 flavor variants globally, from green tea in China to dulce de leche in Latin America. It also innovates through cross-category hybrids like Cadbury Oreo bars or Milka cookies. And with acquisitions like Cliff Bar and Perfect Snack, it's tapping into protein, plant-based, and the on-go nutrition sort of categories. Now, Hershey's here takes a more focused approach. Its R&D budget is about $50 to $60 million annually, less than 0.5% of revenue. Instead of reinventing formats, it leans on line extensions. Reese's with pretzels, zero sugar Hershey's, or seasonal Kit Kats. Whether it wants new categories, protein bars, sugar-free chocolate, better-for-you snacks, it often acquires instead of building themselves. Example, Lily's One brands and Amplify. While Mondelez innovates for scale and variety across markets, Hershey's innovates for depth and loyalty within a narrower space. Both strategies work, but they aim at different appetites. Chapter 7: M&A and Strategic Expansion. When growth can't be built, it is often bought. Mondelez is a serial acquirer, but with a purpose. Since 2018, it has picked up Tate's Bake Shop, Premium Quickies, Chipitia, European Cakes, Ricolonio, Mexican Candy, and Cliff Bar, its biggest deal yet at $2.9 billion. Now, the goal here is simple, which is to fill product gaps, expand in emerging markets, and double down on snacks. At the same time, Mondelez has trimmed the fat, spinning off coffee, selling in gum business in developed markets, and narrowing its focus to chocolate, biscuits, and baked snacks. Hershey's, on contrast, makes fewer but highly targeted acquisitions. It bought Amplify, Skinny Pop, Dot Pretzels, and Lily's to break into a new snack category. These deals are mostly US based and are aimed at broadening the shelf presence in grocery and convenience stores. Hershey also shows discipline. It exited China, sold its jerky business Crave, and diversified niche chocolate lines that didn't scale. The contrast is sharp. Mondelez expands globally and horizontally. Hershey's rather fortifies vertically and locally. Both are reshaping themselves, but with different maps, speeds, and appetites for risk. Chapter 8: Stock Valuation and Shareholder Strategy. For the last decade, both stocks have delivered, but one pulled ahead. Hershey tripled in value since 2012, outpacing the S&P 500 and Mondelez. Its focus on margins, dividends, and brand loyalty made it a defensive favorite, especially during downturns. It pays a stable dividend of 3%, regularly buys back shares, and has kept its net debt very low. At its peak in 2022, Hershey's traded at a PE of 30x, a premium reserved for few in consumer staples. Mondelez, starting at $26 in 2012, has roughly doubled, but the journey was bumpier. Restructuring costs, currency swings, and portfolio changes delayed investor confidence that changed post 2018 as margins improved and acquisitions boosted growth. Mondelez now trades at a PE of around 21x, with dividends and buybacks totaling billions annually. As of 2025, valuations have converged. Both trade in the low 20s on earnings, reflecting similar expected growth but different risk profiles. Whereas Hershey's offers predictability, Mondelez offers scale and optionality. The market seems to believe both can deliver, just in their own ways. Chapter 9: Future Trajectory and Uncertainty. Now, both companies are strong today, but with their paths from here look very different. Hershey's faces a near-term margin crunch with cocoa prices hitting record highs. It's guided for a 36% earnings drop in FY 2025-26, despite steady US demand. Now, the plan is to raise prices, double down on core brands, and grow salty snacks to offset chocolate pressure. But Hershey's future is still US-centric, and while that makes it stable, it also caps growth. Mondelez, by contrast, is leaning onto the global momentum. Emerging markets now drive over a third of sales, and premium brands like Cadbury and Oreo are scaling really fast. Its 2030 goal: 90% of revenue from chocolate, biscuits, and bars, categories with global tailwinds. But Mondelez also juggles more: acquisitions to integrate, currencies to hedge, and supply chains to manage across 160 countries, and that is no joke. The real uncertainty is speed versus certainty. Hershey's is a fortress, slow moving but efficient. Mondelez is a convoy, faster, broader but exposed. Both will grow, but how much, how fast, with how much risk, that is what the investors have to decide next. Two companies, same category, different blueprints. Hershey's with laser focus, a tight portfolio, deep US penetration, and disciplined execution, while Mondelez plays offense, global scale, diversified categories, and strategic reinvention. Neither approach is objectively better, but they offer different lessons. In investing, product overlap doesn't mean financial similarity. Structure, geography, and strategy shape outcomes far more than surface comparisons. So, whether you're watching chocolate sales or studying global brands, look beyond the label. Sometimes biggest differences live just below the wrapper. So, guys, in the end, I hope you like this comparison of these two snack companies worldwide. And do subscribe to the channel because we'll be bringing more such videos where you'll find in-depth insights about these global companies.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.